Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Brookfield Renewable stock so we can determine if it's a buy or a sell. Brookfield Renewable Partners owns and operates renewable power assets. They own hydroelectric, wind, and a bunch of others. This company is a master limited partnership, which means it pays a lot less taxes than a traditional corporation. The way it does this, it avoids double taxation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. All dividends received from an MLP are taxed as ordinary dividends, which is the higher tax rate. Qualified dividends is a lower tax rate. So for instance, if you own a regular stock like Microsoft and you receive dividends, you pay taxes at the lower rate on those dividends. If you hold an MLP stock in your retirement account and receive more than $1,000 of dividends in 1 year, it is considered unrelated business taxable income, which makes it subject to being taxed immediately. For this reason, some people suggest to not have MLP stocks in a retirement account. Brookfield Renewable is 60% owned by Brookfield Asset Management, ticker BAM. BAM's market cap is $13 billion. BAM is headquartered in Toronto, Ontario, Canada, but this company, Brookfield Renewable Partners, is headquartered in Hamilton, Bermuda, and was founded in 2011. Let's get started with the model. This is a large cap company, 14 billion market cap. They're trading at $32 a share, and they have 450 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2019 and 2020, but negative in 2021 and 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 19 and 22, negative in 20 and 21. Revenue is a sales for the company, and that goes up about 20% from $4 billion to $4.7 billion. They recently released their first quarter earnings, and their revenue in the first quarter was $1.3 billion, up from $1.2 billion last quarter, and up from $1.1 billion in the first quarter of 2022. This most recent quarter is the most revenue they ever generated in a quarter. They mentioned in their quarterly report revenue of $1.3 billion, an increase of $195 million over the same period in the prior year. The growth is due to favorable hydroelectric generation across our portfolio and higher realized pricing. They recently acquired and commissioned facilities, adding 1,823 gigawatt hours. That contributed $54 million of revenue for the quarter. They do have a net loss pretty much every quarter. They did have a small gain in the second quarter of 2022. But a better indicator is funds from operations, which is pretty close to cash flow from operations on the statement of cash flows. And you can see that's positive every quarter. Their funds from operations per unit is 43 cents. It was more in the second quarter of 2022. That was their best quarter in terms of funds from operations, 294 million. They don't issue shares, they issue units since they're an MLP. Up here they show us their energy generation. The actual generation is 19,000 gigawatt hours. LTA is a long-term average. That's a 30-year average based off of a simulation model. And this most recent quarter is the most energy they generated. They never even hit 17,000 gigawatt hours before this quarter. Here's a breakdown of the energy generation by location. 835 gigawatt hours in the US, 295 in Canada, 253 in Europe, 133 in Brazil, 175 in Asia. The revenue in Europe per gigawatt hour is the most by far, $188. That's about 2.5 times the average in the US. EBITDA in the US is the highest at 39 million. Funds from operations is tied in the US, 26 million, also 26 million in Europe. A good portion of their revenue comes from hydroelectric and wind. 462 million of revenue came from hydroelectric, 335 million in North America, 61 million in Brazil, and 66 million in Colombia. In terms of wind, 85 million of revenue in North America. Let's look at the capital structure. 5 billion of equity, 25 billion of debt. They're 16% equity, 84% debt. Their net debt is 24 billion, so they have about 1 billion of cash on their balance sheet. I gave them a WACC of 11.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 450 million shares. And we get a calculated stock price of $33.58. They're trading at $31.58, so they're trading at a 6% discount. It's a buy according to the model. Simply Wall Street has them at $49. They say the stock is 36% undervalued. 5 analysts priced this stock, and the average price target is 34. The lowest 31, the highest 36. 8 analysts priced this stock, and the average price target is 34. They say it's 8% undervalued. This is where the stock has been trading since it IPO'd in 2006. The stock price doubled after 2 years. Then 2008 came, the Great Recession, and the stock came way down, well below its IPO price. It took about a year and a half to get back to where it was pre-Great Recession. It took about a decade for the stock to double. It went from 10 in 2010 to 20 in mid-2019. Then it got up to 30 in the beginning of 2020, came back down to 20 during COVID, then shot way up past $45 over the next year or so. Since the beginning of 2021, the stock has come down quite a bit. It looks like it bottomed out at 25, now it broke through 30, so it looks like there's a good amount of upside potential. They consistently pay a quarterly dividend, and they raise it each year up to 34 cents a share. That's a yield of 4.3%. There are 21 companies in the same industry as BEP, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend more than any other company in CapEx. These are investments in property, plant, and equipment. An example of this is when they acquire a hydroelectric plant. They have a really poor debt-to-equity ratio. For every dollar of equity, they have $5.20 of debt. Because they're an MLP, so they have to give back at least 90% of its profits to its investors in the form of a dividend. So there's not much left over to grow the business. So they have to use debt to scale and grow. They pay a decent dividend. It's at the median. They are an MLP, so it should be higher than the median. Most companies in this field have negative free cash flow. They rank second in market cap behind Constellation. Their price to book is worse than the median average, really bad PE. We can't look at their price to free cash flow since they have negative free cash flow. Price to sale is a little worse than the median, much better than the average. They generate more revenue than the median or average, and their 5-year annual revenue growth rate is at the median. So to summarize, I have them trading at a 6% discount. They've been around 12 years, and I think most people own this stock for the dividend because MLPs, REITs, BDCs, their dividend payment is a lot higher than the average company. Of course, you have to pay higher taxes, something to think about. But if you want exposure to renewables, this could be your play. I ranked their free cash flows 2 out of 10, their revenue 6 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you want to become a member, you can click on the link in the description below. Thanks for watching.